Thank you all again for being here with us. My name is Jamie Terrell. I lead marketing and communications here at Saltmarsh, and we're happy to have you here with us again for the latest in our PPP webinar series. Since we're counting, today marks our 6th PPP webinar. As you probably know by now, we're going to keep them coming as long as needed to ensure you have more clarity as we now move into the forgiveness phase of this funding process. If you're a regular guest of our weekly webinars, welcome back. If you're joining us for the first time, we'd like to welcome you as well, and thank you for spending the next hour with us. Here again, our resident team of PPP gurus who keep us informed and entertained. They are also members of our COVID recovery and response team here at Saltmarsh: Suzanne Cox, Glenn Scharf, and Andrew Kent, all shareholders here at Saltmarsh, and we're happy to have them leading our presentation again today. I do understand since our last webinar, new guidance and FAQs have been issued, so the team is really looking forward to sharing the latest with you today. Before we begin, I do have a few quick housekeeping items to mention. First, everyone on the line has been muted. If you have questions during the presentation, feel free to share them with me in the chat. We do have Glenn monitoring questions as well, so he'll try to answer some of those during our program. And if we have time for Q&A at the end, we'll take some of your questions at that point as well. We'll walk through some common questions together toward the end of our time today. You're also welcome to share any specific questions you have with us by email, and that'll be to ppp@saltmarshcpa.com. Someone from our team will take a look and get back to you directly. Today's presentation is also being recorded. If you haven't been able to join any of our previous webinars, those are all available on our YouTube channel. You'll get access to those videos in our follow-up materials. They'll be sent out to you tomorrow by email, along with a copy of our slide deck and other presentation resources. In that same email, you'll see a short survey to complete as well. It takes just a minute. If you've appreciated these webinars and the information provided, let us know that, and we'll be happy to keep providing them as a means to keep you guys up to speed here. With that, I'll go ahead and hand things over to Andrew Kent to get us started. Andrew, over to you.
All right, thanks, Jamie, and good afternoon, everyone. Thanks for joining us on PPP webinar round 6. So today, as Jamie mentioned, as we continue to kind of roll through this process, today's agenda, we're going to walk through a typical PPP forgiveness application that we're seeing. So we moved into the point now where we're working, helping a number of clients with their forgiveness applications. We're starting to get a feel for where some of the questions or issues are coming up. And so we're going to walk through a typical forgiveness application and kind of highlight some of the common pitfalls that we're seeing. And then we're also going to spend a few minutes talking about some of the latest guidance in the form of new frequently asked questions and interim final rules. So thanks, Suzanne. So the state of the PPP world, a lot of us are wondering, like, why are we still here? It seems like it's never going to end. And the program closed to new, and that could apply to probably 2020 as a whole. The program closed to new applications on August 8th, so there are no more new PPP loans being issued. Most borrowers at this point that we're seeing have exhausted their funds and are now looking at the forgiveness process. But they're finding, for lots of reasons, many of their banks have yet to begin accepting their forgiveness applications. And this is just to kind of share something. We have a large financial institution practice here at Saltmarsh, and one of the state banking associations recently surveyed their members, which are community banks in the state. And out of that membership group, only roughly a third of the banks were not accepting applications at all. Another third of the banks were accepting applications but not processing them, and only a third were actually both accepting applications and sending them up to the SBA. And so, Suzanne, you want to flip over to the next slide and we'll talk about why that might be.
Sure, just real quick on that one, just remember the lender has 60 days to file with SBA once they get the application, and then the SBA has 90 days to review it and file. So keep in mind there still is some time there, and so lenders that aren't accepting are kind of pushing out their timeline, and the ones that are accepting have started their clock, but
That's right.
They still have 60 days.
Yeah, and that timeline's a good point. So thanks, Suzanne, because there are probably a lot of lenders who, given some of the things we're about to talk about, may be intentionally saying we don't want to accept the applications yet because we don't want to start our 60-day clock ticking.
Right.
So why
And
have
we've
things
got
seemed? Yep.
some clients that have said they're, oddly enough, Amex even took PPP applications. And so they're one specifically that I know of that said, oh, we're accepting. And then the client went to file and they said, never mind, we're not accepting. So you may have run across that too, where they're saying they are, and then you go to actually do it and then they're not. And so there's a lot of back and forth and a lot of interesting information right now coming out from banks. So don't get excited. There is time, so just keep that in mind.
Yeah, no, all good points. So why do we think things have slowed down? Why do we think we're seeing what we're seeing right now? Well, the Paycheck Protection Flexibility Act, which we've talked about in prior webinars, but that was the legislation that was passed that extended us from the original 8-week period to the 24-week period. So the fact that borrowers are continuing to have the ability to accrue eligible or qualified forgivable expenses, that's certainly playing a role here. The Flexibility Act also extended the deferral period for up to 10 months after the end of the covered period. So that means for borrowers who are in the 24-week covered period, you potentially aren't facing any payments or anything else or any forgiveness deadlines until sometime well into 2021 for most borrowers. So the Flexibility Act took a lot of the pressure off in forms of immediate financial pressure from the borrower standpoint and the lender standpoint. So everybody slowed down. We think politics is playing a role here, as surprise, surprise. It's an election year, lots going on in Washington. There have been a lot of discussions about implementing a simpler and even simpler certification forgiveness application based on a simple certification by the borrower. So in other words, the idea that's been floated is for borrowers who borrow less than $150,000, that they'll just be able to simply sign a certification. I used my funds appropriately. They won't have to fill out even the EZ application. It would just be a simple certification. And so a lot of lenders are they want to hop. They don't want to process an application if, to find out 2 weeks from now or 3 weeks from now or a month from now, well, they could have just had the borrower sign a simple certification. And actually, in that same survey that I mentioned earlier, more than half the lenders who are not accepting applications indicated that the primary reason they weren't accepting applications was because they were waiting to see what kind of new legislation came out. Another reason is that the SBA has been slow to issue guidance and open its portal. So it just opened its portal this month to lenders to start accepting applications. And so, as lenders were waiting for the SBA to open their portal, just kind of slowed the whole process down. So, Suzanne, Glenn?
Keep in mind that, lenders are scrambling right now still, to get everything organized on their side. For most of them, this involves getting new software, getting a new interface on their website to accept, electronic applications. So I know that there has been a lot of frustration maybe in the media and so forth about lenders and their delay. But, frankly, they're doing a great job in getting, all of this put together so quickly. And so, many of you understand that banks and financial institutions, they have a lot of regulation that they have to comply with. And so when you throw a new loan at them, they have to, check a lot of boxes and make sure they're doing everything correct. And so they can't just rush into these. So have some patience. If your bank isn't accepting yet, it's because of all these things.
Yeah, and I would say, particularly if you're with one of the larger banks that has more IT resources, you're probably getting routine communication from your lender on these issues. We have lots of our clients are getting, weekly emails from their lender saying, hey, we're waiting on, we're expecting this or this, we're waiting on this, our portal's not ready yet, whatever. So if you're not getting communication from your lender, reach out to your loan officer every once in a while. Make sure you are staying on top of that and know where your lender is in the process. So that's kind of, what we're here to do today and where we are. And I'm going to turn it over to Suzanne next to start walking us through our hypothetical.
All right, so if you guys have been a regular on our webinars, you know about Dudley Do Right and his company, but they've already filed. Their bank was already accepting applications. So we have a new client today, and it is ACME Industries. And they are a very well-known specialty manufacturer of, common household products such as anvils, rocket-powered roller skates, DIY, do-it-yourself tornado kits, exploding tennis balls, and of course, birdseed. So I know your first thought is, did you all get copyrights for this? That was Andrew's first question, I'll tell you right now. So because the YouTube webinar is free, it is acceptable for us to use the Warner Brothers and use them as an example. So I know that was a top concern from our legal counsel and probably some of you as well. So ACME's PPP loan. They got $315,000. They were funded on April 23rd. If you guys are going to geek out and follow this example closely, you may want to screenshot this so you've got all the information for later. So key point there is it was before June 5th. That'll come into play later. They do have 28 employees and 4 of those are owners. Another thing that will come into play later. Biweekly payroll also, as we've discussed previously, that does matter, matter based on which covered period they choose, the covered or the alternate covered. And their first pay period after their loan was funded was April 26th, and they ran out of money at 12 weeks. So these are all important facts in walking through our example here. So one of the most common questions that we're getting still is, 8 or 24. There was a lot of confusion around this, and there still is. And so we're just going to cover this briefly just because we're still getting a lot of questions about it. And most of the questions that are coming into our PPP at Saltmarsh CPA email are, can you help me make a decision? Can you help me determine whether I should pick 12 weeks or 15 weeks, or, there are a lot of options. And so the people reaching out to us, clients and non-clients, are asking, hey, can you help me make a determination of which option is better for me? And so if you have that question right now, email us at ppp@saltmarshcpa.com and we can help you make that decision because it does depend on a few different variables. So we're not going to go through all of those in detail today. Our example will be a little bit easier, but again, we can certainly help you with a more complex situation. So if you were funded prior to June 5th, you are allowed to pick either the 8-week or the 24-week covered period. If you were funded after June 5th, you are required to use the longer covered period of 24 weeks. And again, biggest question is, well, what does that matter if I can file when the money runs out? So there are some very specific situations. If you have reduced FTEs to a great extent, if you have reduced wages to a great extent, those are factors that would come into play in exactly, the timing that you want to use. And so while you can file as soon as your money runs out, it may make sense to wait a little bit longer. And we're going to talk about that as we walk through the example, but it may make sense to wait until the 24-week covered period ends in order to recoup what you may have as far as an FTE or a wage reduction penalty, quote unquote. So Andrew, Glenn, anything to add there?
And Suzanne, I'll just one thing, and I'll just point this out. And I think we touch on it maybe at the end of our talk today. But when we talk about the money running out, what we're talking about is we're not actually talking about whether or not you spent money out of a specific account or whether you use certain dollar bills to pay certain expenses. We're talking about, once you've accrued or accumulated enough expenses that fall into the forgivable categories, that you've got your forgiveness covered, essentially, that you've got your loan principal covered. We'll talk about that a little more later on, but I know that's created some confusion for some of our clients who are like, well, I didn't pay for that expense out of the PPP account I set up. We're talking about incurring those costs or incurring those expenses.
That's right. So here is our employee list. And so again, if you're keeping close eye on the forgiveness application, you'll want to note at the bottom the $252,553.85 in total employee salaries and wages. And as you can note here, there's a column for the alternative covered period compensation, and then there's another column for includable compensation. And so as you can see, most of these are the same, right? Until you get down to Marvin the Martian. His are different, and also Elmer Fudd's. Elmer Fudd's are different. So you're wondering, why can I not include all of Marvin's $26,500? Why does he get limited to the $23,076.92? So the reason is because Marvin the Martian and Elmer Fudd are both paid over $100,000. And so they're approximately, if you do the math, they're right around 115,000. And so as we talked about before, salary is limited in excess of $100,000. So these two boys, they are not going to get full forgiveness on their salary because they are over $100,000. And because ACME is filing in 12 weeks, the math is essentially 12 50-seconds of $100,000. So that totals 23,076. So if you were to say push this out and not file in 12, say you were to go the full 24 weeks, you could use an amount for them of 46,153.85. And so you've probably seen that number a couple places, which is why I'm mentioning it. It is actually listed in the IFR as an amount, and you've probably seen it in other, PPP media or articles, things like that. If you run this out the full 24 weeks, you would get to take 24 50-seconds of $100,000, which is the 46,000. So in our situation, though, they have no need to run out the whole time because they have not had a reduction in FTE or wages, and so they are going to file when their PPP money ran out.
And Suzanne, just to highlight that, because that is a common question that we're getting from clients right now, and especially clients who are asking us to review their calculations, and they said, well, the IFR says I can take $46,000 if I'm in the 24-week period. Well, you still are always limited by that, the limitation that you can't take compensation at a rate that's greater, that would exceed $100,000 a year. So anyway, that is something, a very common question, a very common issue that we're seeing.
So here are the owners. You're probably wondering why Wiley and Roadrunner are actually owners when they're always, one of them is trying to kill the other one. But in fact, they are partners in ACME Industries. And so here you'll note that, again, we've got the columns for claimable compensation. And this is important here, guys, 2019 compensation. And so this column wasn't on the last slide. And you're probably wondering, well, why didn't you look at employees' compensation for 2019? Because it's not required. So there is a part of the bill that says that we must do a look back for owner compensation. So if you're an owner, you can't just give yourself a raise in current year and then expect to be able to get forgiven for that additional compensation. You can do that with employees, but you cannot do that as an owner in excess, again, of the 2019 comp. So there are two things to look at here. First of all, owners are limited to $20,833, which is 2.5/12 of their 2019 comp. So when you've got Wile E. Coyote and Roadrunner, they both make $150. They are limited to the $20,833. Now, Daffy Duck and Bugs Bunny, they are also, again, limitations here. As you can see, their claimable comp is even less because they got a raise in 2020. And so when we do the look back, their look back is what is limiting this claimable compensation to $15,000 and $10,000 respectively. So there are a couple things to consider when you're looking at owner comp and how much is forgiven for owner comp. You'll need to do a look back and make sure that they aren't in excess of last year's compensation and they got a huge raise, or not even a huge raise, but a raise, which might bump them out, and so that may limit your amount here. I feel like there was something else we wanted to talk here about, guys. Did I miss something?
No, I would just chime in that this is another one of those issues that we're seeing on a very regular basis, and so and a lot of people don't appreciate the impact that the 2019 comp has on the calculation. And you'll also notice that 2833 applies even if you take it out 24 weeks, and that's because the drafters of the act, yeah, they are specifically, their stated goal is that they're trying to prevent any windfalls to owners, whether you feel like it's a windfall or not. They're trying to ensure that owners aren't paid at a rate greater than they were paid in 2019.
Yes, thank you. That was exactly what I meant to say, was that it's limited to this no matter what. So thank you for adding that. So, all right, we are going to move on here, and I believe Glenn is going to talk to us about health insurance.
Yeah, I am. Thanks, Suzanne. You know, when I first looked at that owner compensation and saw that Marvin the Martian was getting reduced, I thought it was because he was a non-resident alien. But you had corrected me.
That would have been good. We could have added some complexity to the scenario.
Right, exactly. So we'll move past that, and we'll look at health insurance here. And you know, the health insurance costs, you know, are paid monthly. So we got May, June, and July all within our covered period that we're trying to apply for forgiveness for. ACME pays 100% of the health insurance costs, so there's no reduction from the employee side and what they're contributing. However, on the employer side, okay, the owners have to be backed out. We've got an S Corp here, so S Corp insurance costs for owners are disallowed because it's in their cash comp already. So that's the $1,750 to the 4 owners that we're backing out. So our total cost that we're allowed under the forgiveness process is the $14,055. Now, new guidance here, healthcare doesn't mean just healthcare. We have confirmed that it does include vision and dental benefits. So the same would be true in calculating them. Only the employer portion is what is included in the total amount of forgiveness calculation. So this $14,055, that's going to come in later, and we can go on to the next slide, Suzanne.
Yeah, just a second note there about this isn't ACME is an S Corp. If you are a C Corp, healthcare is allowed to be included in your forgiveness. So you would not back out owner healthcare on a C Corp.
Correct. Thank you. So then we've got the 401k contributions. Okay, so each pay period, ACME makes a contribution for all of their employees. Now, to note here, we've got $7,225. Owners' compensation is capped here as well. So the 401k contributions are capped. And basically, it's the same calculation. It's 2.5/12 of whatever their 2019 retirement contribution was. So, you know, that's all, you know, limited so that you can't, you know, put a high number in for owners during that process. The other thing that is new guidance is that you can't accelerate from another period that's outside the cover period or the alternative cover period. So for example, if you have a profit sharing contribution and you have to wait until after year end and have to make all the calculations and your TPA gets all the information, and so then your profit sharing plan contribution may be made in April of the following year. Well, you can't say, well, we made, you know, $20,000 contribution last year, so we'll prorate that and contribute, you know, $10,000 this year or something like that for next year. You can't do that. So you really have to kind of keep it within whatever is normally paid within the covered period.
Glenn, I'll just point out, I was just going to say that, you know, a lot of these conversations that we're having with clients about, well, can I accelerate or can I prorate the 401k contribution because I'm going to make it outside the period? A lot of those conversations were driven early on by clients who were concerned about the 8-week period and whether or not they were going to be able to use all their funds. And so, and you know, what we found is those questions are still lingering as people are trying to get their, you know, their minds around 24-week period. But as a practical matter, the expansion of the covered period to 24 weeks has eliminated a lot of these concerns about trying to, you know, trying to prorate or accrue things like 401k contributions. The need to do that has been lessened somewhat by the extended covered period.
Yeah, that's all I was going to say is in the early part, full disclaimer, we didn't know whether that was allowed or not. So you may have heard us say, in a previous webinar, we don't know. Now we do know, and it is not allowed.
Right. All right. So now we move to the final piece of the puzzle, the non-payroll costs. So this is rent, utilities, interest. Right now here we've got rent that was paid for ACME of $16,333. This includes rent that has been paid or incurred during the period. So there is some, proration, and as long as it's paid within the next cycle, then you're fine. Interest includes only real property loans. Interest on real property loans does not include unsecured loans. So this is new guidance. This was specifically identified, before it had said mortgage interest. And so what were we counting here? Currently, there are also secured property loans as well. It does not have to be real estate. It can be tangible property, but it has to be secured. So that's the key here. So in addition to the rent, they had utilities of $1944, and then they had interest of $427. So a couple of the questions that we've gotten is, well, the lease, for rent or the loan has to be in place before February 15th. And so we've had a lot of clients call and ask us, hey, my lease ended in May and I have to renew. Can I still make those payments? Are those still allowed? And same thing with refinancing debt. So as long as the original lease or the original loan was in place before February 15th, if it's just a renewal of a lease or a refinancing of a loan, as long as that loan is still securing by the property, etc., then everything is fine. You can include all those amounts. Suzanne?
Glenn, I know you touched on this, but the paid versus incurred just continues to be something that we get lots of client questions about. And the simplest way to think about it is like this: if you pay your, if you pay your rent in advance, in other words, you pay on the 1st for the following month, and you're funded on the 15th. Well, you've got the 16th through the 30th of the month. You actually get to include that rent in your rent calculation because you're incurring the rent during the period, even though your next payment cycle doesn't, only covers the, starts for the following month. Same thing with payroll or other utilities. If you incur a portion of your electric bill before your forgiveness period is up, as long as that bill is paid, Glenn, like you said, on the first, in the normal cycle, in the next, the next payment cycle, you get to incur the piece that that happened during your covered period.
That's right.
Thanks, Andrew. Okay, so now here is the finality of all of these numbers. This is the actual forgiveness calculation. And a little bit is some of it can be a little confusing. And so we're just going to kind of walk through line by line here of what each line is and what the numbers that we've accumulated here. So line 1 is payroll costs. So remember that the loan here was $315,000, okay? So just kind of keep that in the back of your mind. So we had, what were our payroll costs? We had our 24 employees, which their comp was about $252,000. We had our 4 owner employees, which their comp was about $67,000. Then we had the health insurance component, and that was about $14,000. And then we had the 401k contributions of about $7,000. So all those add up to $341,000. Now you'll notice that that is greater than the amount of the PPP loan, which is completely fine. The more the merrier here in these first 4 lines, okay? And so that's why we see the 24-week period being more advantageous, because it's boosting these numbers up, and some of the other calculations and restrictions kind of go away naturally. All right. So then we got, the mortgage interest payments, the rent and utility payments. And so all of those are added up and on the line 6. and we've got $360,000 of eligible costs. Okay, now line 5 is the salary reductions, which in this example we do not have any. And then in line 7, we also have the FTE quotient, obviously the maximum being a 1, but we don't have any reductions or anything in this calculation because it just makes things a lot more complicated. And that's why we're doing what we're doing to help clients understand and work through these types of calculations. So here we go into the meat of it. Line 8, 9, and 10 is, okay, what's my forgiveness amount? Okay, so the line 8 is your modified total from above. We didn't have any reductions, so that's still the 360,000. Okay, then we've got the PPP loan amount, which is 315,000. And then finally, we've got our payroll costs must be at least 60% of the total. So we gross up our payroll number. So the 341 on line 1 is divided by 0.6. And so that's how we get this $569,000 number. And so the bottom line is that it's the forgiveness amount is the lesser of these 3. So the lesser in this case is our entire PPP loan amount, which is $315,000. So if they only had, and I'll use some, well, I don't know about some easy math, but let's say their payroll costs were only $100,000 and you gross that up by 60%, and we'll just say for ease sake, that's 160. Well, that would be less than this 315 in the loan. And so your forgiveness amount would only be restricted to that 160. So it's the lower of all 3. And so we've got perfect scenario here. We're getting full forgiveness, no reductions in anything. And so we can just file and be happy and merry and move along on our way. So is it Andrew, you're up next.
Yeah, so to the next couple of slides expand a little bit then on this discussion. So one thing that we continue to get lots of clients question about that people are concerned about is they've heard about these reductions in their forgiveness amount because they may have reduced comp or they may have reduced full-time equivalencies or FTEs. And so this is a recurring question. Lots of clients are worried about, what's the impact if I had to cut people, or what's the impact if I had to cut compensation? As a practical matter, what we're seeing is that these reductions are only impacting a very small number of borrowers. Most borrowers will fit back in that example of the previous slide, meaning that they're going through the process, and because of either some of the exceptions or safe harbors or other things that we're going to talk about here in a second, they don't apply. And so they get to file the easy application, they go straight through, there's no worries. And so why is that? Well, like I just alluded to, there are several things here. First of all, when you talk about a reduction in the rate of pay, you're not talking about the reduction in the amount paid, you're talking about a reduction in the rate of pay. So you're talking about a reduction in somebody's compensation or their actual hourly wage rate. So reducing somebody's wage rate from $10 an hour to $7 an hour. That's a 30% reduction in the rate of pay. Second, we're only including employees in these calculations who make less than $100,000 a year. And the really tricky part to that is it's less than $100,000 a year in any pay period. So for example, if Yosemite Sam's base rate of pay is $750 a week, well, you multiply that out, that's $39,000 a year. So he's clearly under $100,000. But let's say Yosemite is in sales and he gets a $5,000 bonus every quarter that's paid in the first pay period of each quarter. Well, in each of those pay periods, Yosemite's total pay is $5,750, which is an annualized rate of pay of $149,000 and change. And so Yosemite comes out of this calculation because he's got 4 periods a year in which he's paid at a rate of pay that exceeds $100,000 a year on an annual basis. So, once again, there are lots of people that just come out of this calculation at the very beginning because of either how they're paid or how much they're paid. Third, the next thing is there's a bunch of exemptions and safe harbors, and we've been through these, I think, in prior webinars. We're not going to try to get too far off in the weeds, but You know, for example, we get to exclude reductions that are based on, you know, good faith termination of employees, or employees who voluntarily left or voluntarily asked for reduced hours. We also get safe harbors for employees that we had to reduce but rehired within a certain time period. Or there's safe harbors if you were unable to restore, you know, if you're unable to restore your business activity due to guidance from the CDC or OSHA or the Department of Health and Human Security. So there's, you know, when you combine all of those things, the threshold limits, the exceptions and safe harbors, and then just the impact of extending the covered period. We've got 24 weeks now, and so just the fact that we can extend these covered period, accrue those lines 1 through 4, those numbers just get bigger and bigger the more time you let run. These compensation and FTE reductions just become less and less important. And so the next slide, Suzanne, has a quick demonstration of this.
Oops, sorry.
That's all right. So, so this is just an example that shows the impact of the covered period extension. Let's take Glenn's forgiveness application that we looked at a slide or two ago, and let's assume that we actually had $25,000 in payroll reductions, and we had a 25% reduction in the FTE quotients. So when you run the math in, that $360,000 that you may remember from lines 1 through 4 in the prior example, we back out the $25,000, that gets us to 335, 246. Then we have to multiply that times 0.75. That gets us to 251, 434. So now, using those same numbers as before, if you had a salary and hourly wage reduction and an FTE reduction, now we're at $251,000 in the modified total that goes into line 8, and your forgivable amount is the lesser of lines 8, 9, and 10. And so that means that you're going to end up with $63,000 not being forgiven. But look at the table that's right there to the right of it, example 2. By simply letting their payroll run for 4 more weeks, and remember, you can file at any time if you're in a 24-week period, they can let the payroll run for 4 more weeks. They can accrue another $128,000 roughly in payroll. And by doing so, it essentially eliminates the impact of the salary and wage reductions or the FTE reduction quotient, because now you run through the math, the line 8 modified total is now 347. That's greater than your loan amount of 315. And so line 8 is the lesser of lines 8, 9, and 10. Your entire loan gets forgiven. So as a practical matter, though, we're seeing lots of clients are still asking questions, still worried about these reductions. The practical impact seems to be you know, greatly reduced as a result of the changes made in the Payroll Protection Program Flexibility Act. So Glenn or Suzanne?
Andrew, I just want to point out one thing from the chat that I'm getting. One person asked about their line 10 here shows 75%. If you have that loan application, you have the wrong one. That would have been the original loan application before they changed from 75-25 on the payroll requirement down to the 60-40. So just make sure that there are a lot of iterations of these applications because of all the changes. Just make sure you have the latest one that you know, that kind of mirrors what we're talking about here from the SBA, and your bank should be able to provide them as well.
And you can get them at treasury.gov.
Yeah, no, that's a great point, Glenn and Suzanne. And yeah, that's absolutely something to keep in mind. That 60% threshold was something that actually was part of the Flexibility Act. It changed. It was a change from the 75%, which had been issued as part of SBA's guidance. So yeah, anything else on these guys?
That was great. I think that was one of the more important things to get across today. So hopefully you guys were looking alive.
So too much of a good thing. You know, this is another issue that we're starting to see as clients actually bring their forgiveness applications to us. You know, back when a lot of folks got their loans, it wasn't quite the Wild West, but it was almost that, because we didn't have a lot of guidance. People were shooting, you know, there was a lot of, you know, people were rushing to their lenders because obviously the first round of funding was oversubscribed, so they had to close the program. And you know, both lenders and borrowers weren't really sure of all these rules. A lot of the rules didn't even exist when people were applying. for loans. And so we have started to see some issues where people's loans, as we go back and look through the rules now, their loan amounts were incorrectly calculated. If it was undercalculated, there's not a whole lot you can do. What is actually more common is we're seeing borrowers whose loans were overcalculated. And that's something to simply be aware of. It's we believe, based on the recent guidance about appeals that we're going to talk about in just a minute, and other things, it's quite likely that when you get in the forgiveness process, you're going to be asked to repay the amount that you were you were oversubscribed, or you borrowed in excess of perhaps what you were eligible for. So the big question is about what do you do about that? We've seen some lenders actually issuing guidances that says don't repay. If you think you were overpaid, don't repay, because it's going to trigger things that may put your forgiveness in jeopardy. We haven't seen that. I think this is something that you should be talking with your lender about. If you get into a situation where you think you may have received too much or more than you would have been eligible for under the rules that were subsequently published, you need to be in touch with your lender about that. The downside is your loan is accruing interest. So, to the extent that you get down the road and either your lender or the SBA denies a certain piece of your loan as eligible for forgiveness because they determined you weren't eligible for that amount in the first place. A very common example for, is maybe the owner's comp, they didn't get capped at $100,000 a year. So they took 2.5 times their annual 2019 compensation. They didn't cap the people that made more than $100,000 a year. And so their loan is inflated by maybe $25 or $30 or $40,000. You may ultimately have to pay that back. Whether you should pay it back now or whether you should wait till your lender makes a forgiveness decision, ultimately that is accruing interest. The interest is only forgiven on the part for the amounts that the SBA ultimately determines are forgivable. So you may have $25,000 or $30,000 that you're going to have to pay some interest on. The flip side of that is that interest rate is very, very low. The amount that you're actually in jeopardy for is probably pretty small. It's probably worth waiting and going through the forgiveness process and dealing with it when it comes around. If your loan is really big or you think that you've got a bigger issue, that's something A, you should be looking at, and B, that's when you probably need to start having a serious discussion with your lender. Once again, we just bring this up because this is something we're seeing more and more.
Yeah, and the other reason that you could have gotten too much that we've seen is including the employer portion of payroll taxes. And so that's been a common thing that we've seen in an overfunded amount.
Right.
Yeah, I mean, I had a client that told me they got a loan based on their S Corp K1 and they had no wages whatsoever. And so I told them they would have to repay the entire amount because that's not a way to calculate your loan amount.
Right.
Yeah,
they ultimately would have been
that
for it. Yeah. So the appeals process. So this is also new guidance. This was a new IFR that was interim final rule that was just recently issued. If you really like judicial procedure and process, you're welcome to go read the IFR. It's 20+ pages. We're not going to go through the whole thing here today, but just kind of. Yes, it's exciting. Just to keep in mind though, as we've discussed, your lender's going to have 60 days to review your forgiveness application. And then the SBA is going to have 90 days to review your lender's decision. So once again, this new IFR kind of summarizes the appeal process. It provides that reviews of the SBA's loan decisions are going to be heard by the SBA's Office of Hearing and Appeals, OHA. Some examples that they give a possible negative SBA decision. So once again, for example, the borrower was ineligible for a PPP loan. There may be instances where they come back and say, hey, you didn't qualify. A common one might be you have too many people. We've determined now that you meet some affiliation test and we think you have too many people. We're going to deem you ineligible. Or the borrower was ineligible for the amount that they received. So that's the scenario where we were just talking about. Maybe you applied for the loan and didn't back out the compensation for employees that make more than $100,000 a year. And so maybe you received too much. That could be another example of the lender making a decision or the SBA making a decision upon review of your loan. The other examples could be your lender determines you did not support forgiveness for some piece of the loan or for all of the loan. If somehow you manage to turn in your forgiveness application and your lender says none of these expenses are forgivable, then they could actually send a decision up to the SBA that says you got to repay the whole thing. So it's hard to imagine somebody getting into the forgiveness application process and doing that, but that is, I guess, a theoretical possibility. Keep in mind, though, all of this we're talking about is somewhat theoretical right now because you actually have to file for forgiveness before worrying about what you're going to do if you have to appeal it. So anyway, Suzanne or Glenn, anything?
I didn't read that whole 20-page IFR. I left that one to you, so I don't have anything to add.
All right, I think with that, then it's over to Glenn to talk about some of the tax implications.
Oh yeah, turn it back over to the tax guy for all the fun stuff.
All the good stuff.
Yeah, right.
You can see Coyote's tails on fire talking about taxes.
Yeah, it's a real pain in the tail. So yeah, tax questions. That's the big thing. What's happening on the tax side? What's happening, on the income and expense side? So it's been very clear from the beginning that the loan and the forgiveness of the loan, typically forgiveness of a loan, cancellation of debt is taxable income. In the legislation, they specifically excluded the forgiveness of the PPP loan from tax, from including it into income. However, in relation to that, then the IRS came out and said, well, any expenses that go towards non-taxable income are therefore non-deductible. So if you got a $315,000 loan and you paid $315,000 of expenses, your loan's going to be forgiven, but that $315,000 of expenses is going to have to added back when you file your tax return. Those are non-deductible expenses. Congress never intended them to be this way. And we're not sure if legislation would ever fix this. There's apparently not much meat behind wanting to fix that. So I think it's going to be that way. Now, here's the problem that people are asking. Well, I spent all the money in 2020, but my loan, because I delayed filing, or my last day for was too late, and so my loan application was processed, and I got my forgiveness in 2021. So what do I do with that? It is my opinion that you should not file a tax return until this process plays out. So if you have not heard of your forgiveness before, if your tax return is due March 15th or April 15th or whatever that is, then you should plan on extending your tax return. If you have applied for it and your forgiveness is accepted, then you can file your 2020 tax return and exclude the expenses accordingly on your 2020 tax return. So that is, some people have asked, well, my loan forgiveness happens in 21, so that's when that is forgiven, but my expenses were in 20. Do I have to wait until 2021 to add them back? I don't think so. I think that when they're incurred is when they become non-deductible. But once again, wait until you find the forgiveness process has played out before you file a tax return.
So Glenn, just one point here, because this may be, people maybe, well, what is the real practical impact of this? For a lot of small business people, especially in a lot of professional firms or other where decisions are made at the year end about distributing income, through, distributing out to shareholders or owners, this potentially raises a lot of real complications, I think, for business owners, because they may have to make distribution decisions at the end of the year that are going to then be reflected on a bunch of people's personal tax returns, that if there's a later forgiveness decision that changes things, that means a bunch of accounting is going to have to be, redone. And that means all your partners and everybody should also be delaying filing their tax returns, correct?
Correct.
Yeah.
And so, and one last thing about about sole proprietors, Schedule Cs. Okay, this is where it's really confusing. If I take a Schedule C and I take an S Corp and I make them exactly the same, all the same numbers, at the end of the day, you know, the C Corp has $20,000 in income, in net income. The S Corp has no income, but the owner got $20,000 of wages. So obviously, you know, the deduction is not going to be allowed, but the owner got a W-2 for $20,000. Well, they're going to include that on their tax return. Well, a self-employed person who has $20,000 of forgiveness doesn't get a W-2. So then what becomes of that, quote unquote, the forgiveness of their loan amount for their profits? And we think that there may be a component of that may be taxable to them as a recipient of, quote unquote, wages, essentially, and not as a business owner in forgiveness. So it gets kind of confusing for a Schedule C. We're still hoping for guidance on that, but once again, we've got plenty of time to try and determine that for you Schedule C owners, but I'm hoping to expect some guidance related to that.
Yeah, and just on the gap side, to add the flip side of this, I have been getting a lot of questions on that. For financial statement purposes, if you have not reached a decision by year end, that loan will remain as outstanding debt on your financial statements until you receive SBA notice that says you are being forgiven for X amount. And at that point, you could write the loan off and put it to other income. So that would be the financial statement side of that. So,
Suzanne, that could have implications though for borrowers who have to file a gap and who may have debt covenants or bonding requirements or other things. That timing of that forgiveness and whether those are written off, that could have some impact, correct?
it has significant impact, and we've talked about it on a couple previous webinars, but yeah, we can touch on it real quick. You know, if you have debt covenants that include ratios, you know, debt to equity or debt to tangible net worth or anything that includes debt, you know, your lender obviously may know about this loan, but they may not have, you know, recalculated your covenants to see like, hey, you may fail that covenant. And so you may need to talk to your lender about getting a waiver or, you know, adjustment of that covenant for this year or, you know, something. So be on the lookout for that early. If you don't expect to see that forgiveness by the end of 2020, you know, make sure that everyone in your circle understands that this, you know, you have a PPP loan, this might be an issue, you know, start computing ratios early, get with your construction, if you've got sureties, you know, waiting on financials, and this may throw you into a, you know, different category from a surety perspective, you know, make sure you're having that discussion early with these people so they're not surprised at your end. So definitely some financial statement impacts that could affect you. So let's move on to some frequently asked questions that we've either gotten with your registration and or we've just been taking a lot of questions internally. I know I've seen Glenn answer a few in the chat, so Glenn, feel free to pop in if you have any additional ones. Andrew brought this up earlier, but let's touch on it again. Do you have to pay expenses out of your designated PPP funds? So if you got a loan and you put it into a specific account called PPP money, do you have to pay all of your PPP expenses with that fund or that account?
Yeah, the answer is no. So, you know, originally when these things first opened, we advised clients to put them in a separate account, mainly for tracking purposes, so that you could transfer out so they could easily see, okay, how much money they've spent, how much money do they have to go. This 8-week period was, you know, very stringent. But as they moved to the 24-week period, it became less and less of an issue as people are being able to spend more and more of the money. If you can't spend over the 24-week period, then you know, then that's another problem in and of itself. But no, if you have all the money still in a separate account, even though you've continued to pay all your expenses, you're completely fine. It does not have to be designated.
My favorite question, if you guys have been watching our webinar series, is on fuel. So we have been telling you for weeks and weeks that we don't have final guidance, but we do finally have guidance. So Glenn, is fuel considered a utility?
Yeah, Suzanne, this has become your second worst F word that you use next to forgiveness.
That's right.
Anyway, guidance has finally been issued. Fuel is not considered a utility in the sense that, gas that you're putting in your car. Transportation costs are defined as a utility fee assessed by a state and local government. So it's basically, transportation of a utility. I don't think they needed to really clarify that in there. They had just said utility costs, hey, take your utility bill and you can deduct 100, all of it, then you would have been fine. So it caused a little confusion, I think.
It did. So we've covered this one a little bit today, but just briefly, we can talk about it again. Are there any specific guidance for sole proprietors?
Yeah, like we talked about, I mean, certainly the compensation limit, once again, you're limited to this 20,833 if you were over 100,000 last year, or it's 2.5/12 of 2019 compensation. So it's whatever that line, whatever line 31, I think it is on your Schedule C, that's what you're basing it off of. Once again, talking about income and tax, we think it's going to be income to you, but we're not positive for that. Can't include any kind of, it says 401k contributions if you have a simple 401k, or even if you have a SEP or an IRA or anything like that, you can't include any of that, or you can't include health insurance because all of that is paid out of your compensation. So they've specifically excluded those items from sole proprietor calculations.
All right, well, this one's a quick one, but important. As we mentioned earlier, a lot of people are getting frustrated with banks. So we have gotten the question a few times, can we go ahead and submit our application straight to the SBA and just take the bank right out of it?
Yeah, well, when I was a little kid and I wanted to rush through something, my mom's favorite phrase was patience is a virtue. And so that's what I would refer back to here is patience. You cannot file directly with the SBA. You must file with the bank that you got the loan from. Then they are to process it and then pass it on to the SBA. So you just got to wait until your bank is taking applications. I know that some banks, for example, Trustmark Bank, I got an email from them the other day that said, they are accepting applications now only for loans over 150,000 because they're still waiting on those, that guidance, or they're hoping on, the legislation to fix that.
And frankly, if I had a loan under 150, I, as a borrower, would be waiting as well, because I'd much rather not go through the forgiveness process unless I had Saltmarsh doing it for me.
Yeah, absolutely.
So last question here, unless we've got some in the chat, and I know we're running right up on the hour here, is what if you bought capital assets during my covered period?
Yeah, so we really don't see a problem with this. I mean, as long as you have payroll, as long as you have the other covered costs, and you go through the calculation, it really doesn't matter how you're running your business otherwise. If your business needs capital, capital equipment, then buy capital equipment. I mean, hopefully, if you're doing that, you're not using those funds to do that. Now, certainly, if you use the funds to buy that equipment and you don't have payroll, then that's a problem. But just normal business operations, buying inventory, buying capital assets, etc., it's perfectly fine.
All right, well, I cannot do an imitation of Porky Pig.
I was wondering if we were going to get that.
I wish. I had not perfected that imitation. I don't know if any of y'all can, but you're welcome to throw that in right now for our amusement. No takers? All right, well, sorry, guys. We don't have any of that for you, but I am going to pass it over to Jamie to close it up here.
For the record,
everyone.
That is not why I came back here.
You can't do it either?
Well, I don't know.
We can do the wink.
To go ahead and close things out, as Suzanne mentioned, we are at our hour mark here. We still have some unanswered questions in our chat. And so for those of you who haven't gotten a response back, know that we'll follow up with you by email offline. Our team will get back to you directly there. So thank you guys for joining us again. Thank you for all the great questions. Thank you to our team. As always, great session. Lots of really helpful information covered. And so we do want to close with just another reminder to you all that we are here to help you in this process. We know that there are still some questions we don't have answers to, but know that our team is very focused on this. If you do want assistance addressing any questions, even preparing your full application based on whatever scenario works best for your situation, we're happy to advise you on that as well. Our team is shown here. Feel free to reach out to them. Also, you're welcome to contact us at ppp@saltmarshcpa.com, and we'll certainly get back to you that way as well. For those of you who joined a little bit later, I know I've gotten a couple of notes about where they can get their hands on these slides, the recording. We'll send all of that to you by tomorrow afternoon. You can expect an email from us. If you don't receive that email by chance, I know sometimes our spam filters catch these things and we're not able to get them. You can always visit our COVID hub, our website. That's saltmarshcpa.com/COVID-19, and there's a lot of information, including our webinar materials there for you as well. So until next time, thank you all again. We hope to see you soon. Hope you're staying safe, and please keep us in mind if we can help you at all in this process. We would be happy to do that. Thank you all.
Thanks, everybody.